Hi, everyone. We are very excited that you joined our event. Today, we are launching the Baltic Private Equity and Venture Capital Market Overview of 2020. This report has been done together with all the Baltic Private Equity and Venture Capital Associations, partnering with Deloitte for the second year in a row. The full report is available on the website, balticpevcmarket.com. I have shared the link here on the event chat, and follow our social media. You can get the link there as well. This event will be recorded for those who missed the opportunity to join us today. About the framework of the meeting, Janis Dzenis, Assistant Director at Deloitte, will give us a brief presentation on the report highlights, and then he will have a brief moderated discussion with Rokas, Peciulaitis, Managing Partner and at Contrarian Ventures and Chairman of LVCA, Kristjan Kalda, Partner at BaltCap and Member of the Board at Estonian VCA, and Sandijs, Abolins-Abols, BaltCap Partner and Member of the Board at Latvian VCA. So if you do have questions for Janis or panelists later on, please share those in the event chat and we will try to answer those. So Janis, if you're ready to present, the screen is all yours to share.
Thank you, Gerda. Hi, everyone. So hello, everyone. I'm Janis Dzenis, representing Deloitte Corporate Finance today. First of all, I wanted to say great appreciation and thank you to everyone who participated in developing this Baltic Private Equity Venture Capital Market Overview. This has been the third year in a row where we've done it. I think the second serious year, I would say, and I'm sure not the last one. So thank you all the funds and all the personnel and professional in the funds who've spent their time in compiling the data fields. Thank you association members and administration for managing and administrating everything, and also I would like to thank to my colleagues who've done the analysis and who've prepared the report. Let me run through today. Let me spend hopefully less than 20 minutes, 15-20 minutes on the key highlights of the data and of the analysis. The report is structured in a way that we have the Baltic level, and then we have each country level separately. Now today I will present you the Baltic level only, but I'm sure at the discussion with colleagues from all three Baltic countries, we'll be able to touch upon maybe some more country-specific elements there. All right, so let's jump on it. What has happened during the last year? Well, there's been a growth. It hasn't been as massive as we saw it the year before. We can only guess the reasons, but in 2020, the private equity and venture capital funds have raised in a cumulative of almost 1.5 billion euros in the Baltic states. This is cumulative in the last 11 years, starting from 2010 to 2020. If we dive into the details of this, then on the top left corner, you can see the each year growth, and we can see that this year there was a growth of 138 million across the Baltic countries, which was a lot less compared to the 2019 when we saw almost 500 million euros of additional funds being raised for the private equity venture capital world. Now, in terms of the funds itself, the number has stayed stable. So it's almost 50 funds across all three Baltic countries. On the bottom left graph, you can see the breakdown of different types of funds there that has been raised, and clearly the buyout funds are leading there by size, but the growth-wise though, the gross investments have been, with the highest growth there, and have reached essentially 19%, if I'm not mistaken, 19% of growth into 2020. Now, on the top right corner, you can see a different funding types. Again, these are cumulative for the gray area, and then 2020 for the green area there. Government agencies has been by far the largest contributors to the capital raised, followed by pension funds and then private individuals. One interesting fact is that relatively during the last year, the governmental agency funding increase has been lower compared to the years before. Again, I mean, I don't know whether this is a sign, a sign of matured private equity markets, or maybe a COVID situation is what impacts that. But that is the fact that we have discovered from the data during the last year. I mean, so 2020 has been almost 30%, 28.8% of government agency funding that has been raised there. This is EIF, EBRD, EstVCA, Altum, Credex. Also, an interesting fact is that the funds have become more of a pan-Baltic or cross-Baltic funds compared to the last year. Now, this in 2020, it is essentially almost 82% of funds who have stated that they are ready to invest across all 3 Baltic countries. The figure was lower last year. I wouldn't be able to tell you exactly right away, but the figure was definitely lower there. On the capital available for investments by different fund strategies, we see that. So first of all, yes, so the fund number have stayed the same. We also see that there's quite a lot of capital available in the market, and in fact, if you do a little bit of maths on these figures, then you can see that 700 million euros are the funds that are available, which leaves us to conclude that at the end of 2020, only 39.4% of total raised capital was deployed, leaving the rest of it, 700 million, available for investments. Okay, so I guess that's going to be one of interesting points to discuss at our discussion panel. What are the reasons behind it, and whether that shows some kind of a stagnation or growth possibilities, or lack of opportunities there, or maybe something else. If we go further and dive a little bit more into details of investments itself, then on the top left graph, you can see the breakdown by each year of how the volume and the value of investments essentially across all 3 Baltic countries. And apart from 2017, which I think was a special year specifically in Latvia for the value of the deals, 2019 and 20 has been pretty much similar, which makes us hope that after the COVID crisis, the industry will boom above the levels before. So we can see 183 deals and 92 millions of investments in 2020. I mean, the largest investments that you can see are being done by BaltCap, for example, acquiring Krekenavos in Lithuania, also in Valda acquiring Eco Baltic, and BaltCap acquisition of Ridango. That's for the private equity side. While in venture capital investments, there has been 2 larger investments. One is where BaltCap Nordic Fund 1 and Change Venture invested into Verif, and Karma Ventures and SCSC invested in Modular Bank. On the right-hand side, you can see different types of sectors where the private equity and venture capital is investing, across the Baltics, and the consumer goods and retail has maintained the top priority from all the industries, followed by IT sector and business and industrial services, and then number 4 is energy and environment. In the last year, though, you can see that there has been the highest investments have been especially in computer and consumer electronics rather than anything else. So clearly that industry is picking up. On the divestment side, also a record year, 37 million of divestments value at cost, and the number of divestments also have grown. Now, clearly, this doesn't mean that we haven't included, for those who've participated, remember that the methodology accounts for all types of divestments, even if it's just a partial or divestment there. But nevertheless, the methodology has stayed the same. Some maturity in the market probably is something that we can estimate and we can gather from this. Now, the largest private equity divestments by value at costs in the Baltics in 2020 has been where the Lithuanian partner has sold its stake at Thermory. BaltCap Private Equity has sold its stake at Auto24, and in Energia Verde. While at venture capital side, during 2020, Praktika Venture Capital sale of Televizijos Ryšio Sistemas UAB, company providing integration services of specialized professional audio and video systems, and also BaltCap sale of A Group, and Praktika Venture sale of its stake at East West Agro UAB. And the last summary slide that we have is around gender balance here. So we also had a question to gather the data on how many females and males are working either in portfolio companies of the funds or at the funds itself. Well, we can see that you can see the numbers yourself. So clearly the lowest one is at the investment committees at funds, where we have only 8.5% of females representing, while the number is a bit higher for the overall fund employees, 23%. Portfolio companies, female CEOs 11.3%, and the boards of directors 14.6%. So clearly, there's numerous of research that demonstrates that as more diverse decision makers are, including the gender itself, as better and higher performing decisions we can try to achieve there. And I'm not speaking only for research there. I'm also speaking for the personal and Deloitte experience in our firm there. So this is, in a nutshell, what we wanted to quickly run through. There's lots of details and more information in the report, so please take a look at it. I sincerely feel that you will find an interesting piece of read there, especially those who are in the industry there. So please do. And I think now we can move on to a discussion. So I can see Sandijs. Hi, Sandijs, how are you doing? Hi, Kristjan. Hi, Rokas. Hi, everyone. Thank you for joining for this. I mean, let's start with the overall kind of feel. It would be very interesting to hear your thoughts on what are your impressions on what you've seen from the latest analysis we all did, and whether there's something surprising good, surprisingly bad, any other considerations you guys might have as a top notch, would be very keen to hear.
Okay, maybe I'll start. So maybe first, thank you for a great job. I think our Baltic report gets better and better. So it's the second year, and it's definitely looks better and has more content than last year. So I am sure we are moving in the right direction. What concerns about the points, maybe what caught my eye is and you pointed out as well, Janis, is that there is a lot of dry powder. So we have around was it like 500 million or even more as a dry powder? 700 million as a dry powder in the industry. And it actually resonates with the whole market. So if we look at the liquidity of Lithuania, Latvia, Estonia, so it is high not only among our members, but also among high net worth individuals and in general. So this is definitely one of the challenges the industry has to meet.
Okay, Sandijs, what do you think?
I think, this sort of general observation is that the industry is moving the right direction. The funds raised are increasing in size and across the entire spectrum of the funds. And I think, we see the needed developments in the market. And of course, as Kristjan rightly mentioned, there's quite a bit of money in the market, and that makes our job much more interesting. And it's maybe time is better to sell things than to buy things, but we will manage, I think so. But I think overall it's a positive development in the market.
I think it's obviously I'm coming from a different standpoint. I think both Kristjan and Sandijs are from more private equity side or infrastructure side. I think there's one word that is dominating sort of very aggressively in the industry, and that reflects in sort of disparities in the valuations and maybe multiples of how businesses are valued. I think technology is clearly, the biggest, thing that emerged post-COVID, right? There's being old businesses are being disrupted. Digitalization happened, as there's this funny meme picture running around that who disrupted the company. COVID did, and COVID did, as a matter of fact, as an external factor that no one foreseen. So I think there's three things that come from that technology disruption, and there's a lot of I think what 10-year yield and treasuries is at 1.8%. There's excess of money, there's excess of liquidity, there's excess liquidity both on the corporate side, treasury for potential M&A transactions. We've seen a lot of consolidation, like big companies being built through consolidation. That's more on the buy side. I think in the technology space, there's just there's just a lot of new entrants, both from a corporate side entering to play the VC game. So there's a lot of, as people call it, tourists entering this game where they not necessarily are accustomed to the valuations nor how to value these businesses. And that is really an interesting thing when you take into account the financial engineering happening maybe across the pond in the US with SPACs and that excess liquidity going from more institutional capital. So I think we don't have that yet in Europe, but there's already discussions, I guess, in the Nordics. I think there's going to be 2 new SPACs happening in Sweden. There's a couple of SPACs happening by ex-entrepreneurs in Germany. Surely this is going to be also emerging as a trend. And that is all pointing out to the excess liquidity in the market. Again, that's good for the entrepreneurs and businesses. It's a bit trickier to assess the risk and timing of the current market environment and where we are in the cycle. But I think this is really on the tech side. There's been some winners. I guess we're fast forward talking about 2020, but there's obviously, 2021, but there's also 2020. But we clearly see Latvia got a unicorn just recently. Lithuania had, Vinted raised a $3.5 billion valuation. There's an ample amount of examples in Estonia, but clearly technology is really soft. As Margaret and Justine said, software is eating the world. and doing it at an accelerated speed with excess liquidity. So I think it's a great time to be an investor because there's obviously value in the market, but I think it's great for the entrepreneurs themselves. And I think that why there's not that many transactions, because people don't know where we are in the cycle, to be frank, because no one expected this post-COVID and this excess liquidity to enter the market. So I think we are long-term investors, all of us. We look at, in the rhythms of 10 years as a fund durations and maybe investment periods. So I think it's a bit of a noise in the market. I think we look at it through the lenses of what makes sense for the next 10 years to be invested as a tech space, and playing more on the timing side of timing the technology rather than the market, because I think no one can time the market well.
Thank you, Rokas. I mean, just out of curiosity, but what are your thoughts on this dry powder? I mean, one reason why it could be there is that there's just a huge amount of supply, and there are investors who are willing to invest. Another reason is that there might be lack of opportunities out there. I mean, what's your observation? Are any of these true, or is there something else?
Okay, so if I may start here, I don't think this is because of lack of opportunities. So it is because of the massive printing of money that has lasted for like a decade. So if the central banks in the United States and Europe continue printing like in hundreds of billions of euros and dollars, finally it takes its toll. So and just as a figure, at some point I looked at Estonian central bank numbers, and we had in the smallest Baltic country we had 26 billion in cash. I mean, so it's more like a general problem, and if we look at the new Nordics and we look what is happening in Finland or Sweden or Poland for that matter, everywhere we see the same thing. There is excess of money, and obviously it poses new challenges to our members, because indeed it is now easier to exit if you have good assets, but what are the valuations in this excess money conditions? It's a new environment, and how to manage risks, like Rokas said, it's a big question.
I think to add to Kristjan's point, I think I see it as a pure arbitrage. Through COVID, we had this one development that happened that no one foreseen. Meaning you don't need to meet a person to invest in the company, while you can do the deal remotely and everything. People started doing deals remotely, and as a matter of fact, firstly, the first stop for US investor was to enter Europe. And I think we, from a technology standpoint, at least from a company perspective, we have some great companies out here. And even however you want to look at that metric, we have both, if we combine 3 countries that are 6 million of population, they're better than probably a lot of European countries in terms of how many unicorn companies valued over $1 billion we have. We're even better on a standalone basis than Spain, Italy, even Poland, that has pumped billions of dollars. So as a matter of fact, I think people realize that there's an arbitrage on the valuation side. If you look at the Baltics, there's an arbitrage to the Nordics. If you look at the Nordics, there's an arbitrage to London and Berlin. And then there's an arbitrage Europe in general to the US or around the other countries. So I think this has happened, that people, drop the shield that's saying, oh, this is Baltic, weird. No, people actually start investing. We see a bunch of US investors entering and competing with local funds. And as a matter of fact, it's hard to compete with someone when your AUM is, 15 to 20 million to someone that has like 700 million AUM. And if you compete on valuation game to compete with those parties. So I think this is really a good development, because there's foreign investors coming in with skill set and a lot of experience to help to build these companies. And again, especially in the early stage venture, I think that's where the companies need a lot of resources. I think private equity will continue to have this edge because they know better the founders, companies, and it's more rational valuation metric, right? Like for EBITDA, you don't look for revenue multiple. And I think in venture, this disparity will continue to go that route. It's going to continue to go south and get more competitive. So I think in general, the EIF positioning, I'm saying, oh, there's going to be a regional dominance of funds. I think that's going to vanish. And that's the new dynamic post-COVID, which no one actually foreseen. I think it's good for, again, the entrepreneurs. They have many more choices. There's no weird backward, perceptions that were necessarily somehow before induced, that there is just poor quality of founders. I think we have repeating this, infinite wheel of producement of founders coming from existing companies like Pipedrive, Wise. We're going to have first IPO, probably Vice or Vinted, probably Wise more likely in the near future. And these creates new breed of entrepreneurs that go to build business. I think this flywheel is already on a full speed spin. And I think this is going to be a development where obviously we'll see more familiar faces from foreign countries coming here and trying to win these deals here. And that is, again, the disparity, I think, of the valuation is one, I think, meeting point that I think this dry powder exists. And again, another point to, I think, our region dynamics, if we look at the dry powder, in reality, there are two gigantic funds raised by Kalda and BaltCap that has been raised just a year and a half ago or a year ago. So that's just why we have that dry powder, because they're now in investment period and they're going to go to continue to deploy these, which is like something like 400 million capital. And I think in venture, we don't have that excess dry powder. I think we actually even on the opposite have a gap, to be frank.
Yeah, well, as regards to the two funds that you mentioned, I wouldn't exactly call it excess funds or dry powder, because as you rightly mentioned, the funds are just raised and we are really hard at work investing the money and going at pretty good speed, considering what we have done so far and considering our pipelines. But getting back to Janis' question about what's going on in the market, I think the answer is pretty simple. The quantitative easing has taken its toll, and that's what we have to deal with. And I guess there's nothing more to add to what the guys already said. So.
Okay.
And I think, Janis, one important part is that there's always an exit that we talk about, right? So people who exit businesses have to deploy that capital somewhere as well. So that capital recycles, right? So I think this recycle element is going to be quite accelerated because it's a good time to sell a business, right? The multiples are high. So I think that money doesn't go somewhere, disappears, right? It goes back to the market one way or the other. And I think that's going to create even more excess liquidity because people might take more risk and then maybe they will go to be the LPs. And I think this is also a very interesting development, which we haven't had yet through the last 10 years. I think private wealth management, family offices, or similar institutions did not really exist over the last, they existed to a small scale, but they were not necessarily active in these spaces or in direct deals. And that has been developing in the US, where a lot of family offices now start to do direct deals at BCD levels or do buyouts even. So I think that's also something to follow.
True. I think that is exactly what we saw from the survey, that there's still an opportunity from the private investors to enlarge their proportion compared to the, for example, governmental institution investors. Turning to the outbound investments, we also saw from the survey that the outbound investments have reached a peak of 43 investments during the last year. The growth has been massive. If we can see the cumulative number of around 106 million of outbound investments, then during the last year only, it has been almost 59 million. So more than a half has been there. And the countries that are represented, the countries of that are receiving these investments are Finland, Denmark, Sweden, UK. What are your thoughts on this trend, and do you think this will continue?
Oh, it's my favorite part, obviously, outbound investors. So I have been, some of you have been pressing about having it, because what I see is and it concerns our community, small community, our fund managers, that actually to make a dent globally, you need to go outside. So we cannot do business only in our home countries in the Baltics. So we simply have to do business outside. And hopefully I see many of our members successfully investing in other countries. So if we look country by country, obviously closer countries like Finland or Sweden, they stand out, but there are also investment in the United States and then elsewhere in the world. So how I see the future for us is that we have to grow out, and this is how I hope we see ourselves. Like we see as networkers who have these global networks that get stronger and stronger, and maybe in some cases we can help each other to find and participate in deals outside the Baltics. And this is how we can be bigger than we actually are. And so I hope we can continually measure it and see more and more successes coming from investments that are headquartered outside the Baltics.
Yeah, I think there are two sides to this question. One is, related to local funds going out and investing abroad, and that's, I guess, a question of ambition and strategies and so on, growing outside the Baltics is great, and why not? But what I actually like even better when we invest in local companies and then we do add-ons, outside the Baltics, and that's probably kind of, at least for me, it's the most preferable way to grow and to make outbound investments to the local companies that expand abroad. So, and we see more and more these, at least in our portfolio companies, we have quite a few acquisitions abroad, and I think we'll just keep moving in the same direction, and that outbound investment amount shall be growing.
I think I'll look at the question a bit differently. I think one needs to remember history to understand the future. So I think the history says that by design, we're sort of majority of the LP money came from EIF, which by design created this, that it's locally supporting capital and building ecosystem from the first day when it started, right? BIF had that similar geographical sort of constraint. I think by design, I probably, with exception of BaltCap and maybe a few other players, all funds in the Baltics are emerging managers. And emerging manager is defined by LPs from fund 1 to fund 3. Only in fund 4, they kind of qualify you as you're not emerging, but established player. And what's interesting from that duration, if you think about funds, you're likely looking at something like 20-year period to not be an emerging manager. And by design, we're only like 10 to 15 years as an ecosystem. I think everyone is an emerging manager. And what happens with emerging manager, strategy emerges the same way when you emerge. And that's when someone says that you are an established player. And with that actually happens interesting things. You go through these 3 generations of funds where you flock when initiation, you flock with the government money. EIF is still a government, right? We're part of the European Union. And then you kind of go towards a more broader LP base, which is more institutionalized. So the more you progress with the fund, with the more like the firm, not even the fund, with funds, series of funds, then you add on these more professional institutional investors that would give you the trust and the flexibility to invest more. So I think this is the by design. So then, as I think Sandijs said, it's important to understand the ambition. Maybe someone wants to be the dominant player across different value chains of the private equity and venture capital, from early stage to infrastructure. And I think there's a couple of players that are clearly doing that correctly, and then have them additional ambition. I think from our respect, this is different. So I think we want to grow through fund 2, 3, and then we're a specialist fund, and we want to go and compete on European level, and we treat it as any other fund in that respect. So I think, again, that's ambition and strategy. But I think we're just going through that solidification where there's going to be 2nd, 3rd generation of funds that are being, and that quality of level of LP will determine whether these companies, management companies or fund management companies, can be ambitious to go to other geographies where the LPs would trust them to execute that strategy. Again, so I think that's a very pivotal time in our development of ecosystem, where certain players will go that route because they will be able to attract and pitch to those LPs that let them to execute that strategy. And I think this is really what drives it.
Okay, we have a couple of questions from the audience and one comment also from Preet. Preet is saying that Rokas made a good point. This is referred to your previous answer. Due to historical attractive returns, private equity, venture capital, as well as developments in technology, private markets have become closer to public markets in terms of liquidity and impudence, and it's easier to screen and analyze and approach business owners, management in private markets across the borders. So the difference between the public and private markets is becoming more of a technical, and that is definitely a challenge for local private funds.
And that's good because asymmetry disappeared, right? Everything disappeared from an informational standpoint. I think that's why we as Baltic funds can go and compete in Sweden, because that information is available. It's a matter of whether you are a trusted brand that someone wants to partner with you, and that's entrepreneur's choice. And then whether you can compete on price, that's another one.
Yeah. Then we had a question from Alvar: how much of the excess capital is European and how much is North American or Asian? You know, I wouldn't be able to, Alvar, to answer very precisely, but clearly the majority of funding is coming from the European institutions, European pension funds. On the private individuals and corporate investor and family offices side, you know, it is definitely the smaller amount compared to the first two, but I don't think we have the data on that. Also a question from Shvetab that asking for other examples. I think, Shvetab, if you take a look at the report, you'll be able to see some of the top investments there, and we can see there. All right. Right, we have well, a bit less than 10 minutes left.
Maybe I can comment on this Priit's comment on Rokas. So what concerns a comparison of public markets, private equity and venture funds are always compared against indexes and the public markets, and our institutional investors are doing it on a regular basis. So and then the question remains, either you do a better return when on the public markets, or you just provide some risk diversification. So this comparison has always been there, and we have to take it into account. I think many of our players currently, they have only their first funds or second funds. It means that they still have to show the returns and that they are able to kind of survive and beat the indexes. But then again, I mean, it's too early. It takes time until first-time managers get their portfolios full and get their exits. So I'm keeping the fingers crossed that we have smart people and get maybe better return from our venture and private portfolios than on average in Europe or United States.
And I think, adding to Kristjan's point, generally for any of the fund operating in the Baltics, the emergence of this US or any foreign capital is a good development, right? Companies generally don't want to go public quickly. I think we don't have a public market. So for us to, like, we have a NASDAQ, but it's not as one would probably want or assume, even comparing to Sweden, and then not even compared to London or any other places like Germany or even NASDAQ in the US. But what it leads to, I think, what I feel from an LP standpoint, why Baltics is interesting space is fund sizes are not big, meaning you can actually make on a multiple cash on cash level, like really, really great returns. Problem for them on that side is that they can deploy very little amount of money, right? Because they want to deploy large amounts of money. So maybe that's a threshold that will change eventually over the next couple of years. But on the other side, like the valuations, at the price that you enter or buy the business really matters, right? Like, so what we're seeing in US, some of the valuations are literally ludicrous. Like if one looks at an averages of acquisitions for the last 20 years of an M&A transaction or IPO even, on average, this does not qualify that these investments are actually going to yield a 10x or 20x outcomes. So I think while the kind of general push and answer to that is by those funds, is like the markets are increasing, realization happen, et cetera, so the TAM is increasing. But in reality, this is an estimation in a formula that is rather complex. So everyone is operating that the next company achievement is not a unicorn, it's actually decathlon, like 10 billion outcome or 100 billion outcome, which we saw over the last couple of years, right? Coinbase, now there are many examples, but people look only at the outliers, they don't look at averages. And that's what really scares me, I think. So I think this is really a good outcome for us when this capital finds in the Baltics, where our companies get actually valued at similar valuations to US. The only big difference is that we entered those companies 10x lower valuations, and that really what makes 10x, 20x funds. And I'm very in big belief that there will be funds that will be top 1% performing globally funds here. Though the problem still comes back that LPs say, oh, but it's too small of a fund. 50 million fund to make a 10x, you need a probably like a $5 billion exits, right? To return a 10x. Though on a 20 million fund, you need way less exits, right? So your total AUM of exits could be smaller. So I think this is an interesting development, how these funds will shift from like a 10, 15 million fund, especially in the venture side, to maybe being funds of 50 million fund, and then actually playing the game of like European guys and showing that you can actually play on the same boundaries here and maybe have that arbitrage to your benefit. And I think that arbitrage is still not going to shrink in that fast because there's still some asymmetry in the sort of geographical spatial disallocation of us being a bit more remote or not having a different language or maybe having a different culture and other things.
Lab is asking, how do you see the effect of IPOs like Wise's on the emergence of the new founders, and also, you know, any thoughts on the talent situations in the Baltic?
Well, talent is always scarce, and also in the Baltics, and this is why, well, one angle is that we can grow the talent ourselves, like the guys in Estonia are doing with this new coding school that is a completely private initiative. And some of our members are also involved in this initiative. But secondly, it is going outside. I mean, you have to find the talent and also do some of R&D in other countries. I mean, it will be limited, not because of that our nations are not talented, but because simply the number of people, and also we are a bit of victims of our own success, because there are so many successful companies. There are also multinational players with their R&D centers, especially in software development that are built in the Baltics. So it all puts pressure on the talent. So yeah, that's my comment on it.
Okay. Maybe let's touch upon the divestment side also. You know, we've seen quite a lot of divestments during the last year. Do you think this kind of demonstrates the maturity and as Rokas was mentioning, you know, the recycling of the capital, increasing the elements of recycling of the capital, or do you think there are any other reasons for that?
Well, if 2020 was good, then I have to tell you that 21 is even better. That's for sure. You know, in the last 6 months, we have sold, I think, 7 companies. So, and I guess answer partially lies in excess liquidity in the market, and this excess liquidity being on the corporate side as well as in the asset management side. So.
I think it's fairly simple to assume that even for like large companies, that more traditional companies, not tech companies, when you have a treasury where sits cash in your bank account, you don't want to pay dividends, you want to grow. I mean, you don't look at 10%, 1%, 1.8% yield on a safe investment like a government bond. What you do is you look at where your growth is, how to increase that growth, and to not be, either through investments in technology companies, even like traditional businesses are now investing in trying to shape what they will look as a company in the next 10 years. And I think with private equity, especially as a partner in that, that realization comes way quicker, right? I think that because the private equity partnership in that relationship is to actually help them to think about strategy in the next those 10 years while they're doing their operational things as a company. So growth is the name of everything now, right? Like companies are valued on growth metrics, not on EBITDA metrics. No one cares about EBITDA in at least tech world, at least as a matter of fact. But it's actually, there is a spillover effect happening into even more established companies that growth matters more than a stable cash flow and really the liquidity the company has. So I think this will continue with this low interest rate environment and excess liquidity. And as a matter of fact, like we will see way more excess liquidity. Like even Lithuania alone, haven't even started to like actually distributing this COVID relief program because, I don't know, for other reasons that I don't know, I'm not in politics, but But this is another excess capital that no one had in that equation, which will change dramatically the exit scenario or growth scenario of these companies. And if there is a reason for one day for Lithuanian or Latvian or Estonian company to believe that they can be competing on an international level, why wouldn't they? They should go and not sell the business and go out compete maybe, as slower moving competitors in Western Europe. And I think we have that drive. I think we as Baltic countries, we're still first, second generation of wealth. People are still aggressive. They want to work. It's I think mindset thing. They want to compete. They want to become big companies being built. And I think that we're already seeing some quite good examples, even not necessarily private equity backed companies that are dominating and competing all across the board in their respective categories. So I think this is going to continue to be, because with successes, we have even more ambition coming from younger people going into this business and building businesses. And I think this is a good momentum that we're having as all countries.
I would like to bring in one more angle. I think that becomes more and more important in this excess liquidity is asking yourself a question: what is your impact? What is your impact on society? What is your impact on environment? And if this investment, say for example cryptocurrency, that is a very modern thing. So, but does it have a positive impact on the society, or it doesn't because of its high energy needs and recycling criminal money? So I think this question maybe helps to set the sight. So what is the impact of your investment?
Okay, I think we're running out of time here, but the last question from my side to everyone is, what do you think are the top, let's say, 3 things to be done during this year or next year, to accelerate the private equity venture capital industry in Lithuania, Latvia, Estonia further?
Can I only say one? I think have the best event in the decade in Lithuania and invite all the people that we know from foreign countries to see how good we're doing, and make relationships that last, and I think invite more capital to here to co-invest.
Yeah, it's a good point. So finally we can meet in person, I hope. So we already postponed last year, so I'm really looking forward to our next VCA summit. But maybe to bring out some other angles we are working on jointly in our Baltic community. One is with geographic positioning. Are we part of what? So is it New Nordics? Is it Central or Eastern Europe? But I see more and more clearly that we have to be part of some bigger block and also act like being in a bigger block. It means also tighter cooperation with Finnish Venture Capital Association, Swedish Venture Capital Association. This is all also happening in parallel. Yeah, so maybe, and tightening, obviously, continuously tightening cooperation between ourselves, so that we are looked at as one coherent market.
Yeah, just to add, I think that there are a couple of themes that we should still be working on very hard. One that Kristjan partially touched upon is ESG topic, and how we as a community or industry will really make an impact, and will not be just talking about ESG and making reports, so that it really matters at the end of the day. And then we need to kind of make sure that on the political side, the achievements that have been made in the industry across the Baltics haven't been erased by some silly political decisions, and to make sure that there is sufficient government support for the early stage funds, and the pension systems function properly, and so on and so forth. So yeah, I think those are a couple of things that will matter.
All right. Thank you very much, everyone, for providing answers.
I think, Janis, by the way, this is a great tradition that I think we've built, and hopefully we'll continue to do for the years to come. I think their support is a good solidification, and just as Kristjan said, just generally building a relationship with ourselves and really trying to figure out and evolve how we position ourselves as a region. And I think we're on the right track and direction.
Good stuff. Thank you guys for discussion here. Thank you.